Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Insurance is the only product where consumers keep on paying the premium but hope to never use it in their life. A paradox of financial planning that 96.3% Indians have no proper access to. Now, this figure is as per the Niti Aayog Annual Report 2024-25. This week, ICICI Prudential Life Insurance and HDFC Life both declared their results. So, in this video, we will primarily concentrate on ICICI Prudential's financial performance for quarter 4 of financial year 2025 and then compare its performance with HDFC Life. So, let's begin. India's life insurance sector presents a complex dichotomy where private players like HDFC Life, ICICI Pru Life have achieved a CAGR growth of 18.78% over a period of from 2020 to 2025. But insurance penetration remains stagnant at 3.7. Now, this paradox stems from structural issues. The most prominent of these issues is mis-selling of the insurance product. Now, as per IRDAI data, 58% of life insurance complaints in the financial year 2025 related to mis-selling, where agents prioritized high commission ULIPs over term plans. Rural areas face acute exploitation. A 2024 MicroSave study found 73% of lapsed policies occurred due to agents hiding surrender charges. ICICI Pru's 89.1% 13-month persistency suggests better consumer retention than industry average of 82.4. But systemic risk still persists. The second issue is with Budget 2025 ULIP taxation overhaul. Now, the government introduced a 12.5% long term capital gains tax on ULIP withdrawals where annual premium exceeded 2.5 lakh rupees. While aimed at curbing speculative investments, this directly impacts ICICI Prudential's product mix, which consists of ULIPs, which constituted nearly 50.8% of the annual premium equivalent in quarter 3 of financial year 2025. HDFC Life, with only 38% ULIP exposure, stands less affected, highlighting strategic divergencies. Thirdly, private insurers captured nearly 62.4% of new business premiums in financial year 2025, driven by bancassurance tie-ups and digital onboarding. Now, ICICI Prudential's embedded value grew nearly 13.3% to 47,591 crores, leveraging its strong 5,900 plus bank network. However, HDFC Life's merger with HDFC Bank created India's largest bancassurance platform, giving it distribution scale advantages. Analyzing ICICI Prudential Life's quarter 4 financial performance, the net premium income stood at 16,369 crores, up from 14,788 crores a year back, which is a 10.7% increase year on year basis. Profit after tax stood at 385 crore rupees, up from 174 crore rupees a year back, which is a huge 121.8% increase year on year basis. Value of new business stood at 22.7 compared to 21.5 a year back. Now, the profit after tax surge reflects cost optimization. Operating expenses grew only 9.8% year on year basis versus 13.2% premium growth. However, annual premium equivalent growth lagged analyst estimates by nearly 7.3%, signaling challenges in onboarding new customers. Assets under management as of quarter 4 of financial year 2025 stood at 3.09 lakh crore rupees, which is a 5.2% increase year on year basis. Embedded value stood at 47,951 crores, a 13.3% growth. Retail new business sum assured stood at 3.32 lakh crores, a 37% increase year on year basis. Solvency ratio stood at 211.8 crores versus 195 of HDFC Life. The solvency cushion positions ICICI Pru favorably for IRDAI's proposed risk-based capital norms. However, HDFC Life's lower debt to equity ratio of 0.06 versus 0.109 of ICICI Prudential provides better balance sheet flexibility. ICICI Prudential declared a final dividend of 0.85 rupees per share, maintaining its 10% yield, significantly below HDFC Life's 0.28%. This reflects divergent capital allocation strategies, where ICICI Prudential reinvests 92% of its profits into tech upgrades and rural agent network. HDFC Life prioritizes shareholder returns with 45% payout ratios. It is said that God is in details. So let us go into details. Now, if we closely check or analyze the quarterly results of ICICI Prudential Life Insurance, you will notice that the quarter 3 of financial year 2025, the performance for that particular quarter was in contrast with the previous quarters. What had happened is there was a paradoxical collapse in revenue alongside growth in profits. So, where revenues had drastically dropped in the quarter 3, so December 2024 quarter showed a drastic drop in revenue, but the profits had increased. Now, for December 2024, the revenue collapsed to reach 4,536 crore rupees, down from 25,158 crore rupees in the September 2024 quarter, a 82% decline quarter to quarter basis. This represents the steepest quarterly revenue drop in the company's recent history. What was the reason for this drastic fall? Firstly, ULIP played spoilers. The 12.5% long term capital gains tax implemented on ULIPs announced in Budget 2025 likely triggered advance redemptions in the quarter 2, followed by a sales drop in quarter 3. Now, seasonal premium always has collection patterns. Insurance industry typically sees front loaded collections in quarter 1 and quarter 2, while quarter 3 experiences seasonal weaknesses. Thirdly, the market correction that happened from September 2024, where the markets corrected nearly 7 to 8%, also disproportionately impacted ULIP heavy insurers like ICICI Prudential. I have already told you that their annual premium equivalent in ULIP stands at nearly 50.8%. So, where on one hand the revenue dropped by nearly 82%, on the other hand, profit grew. The net profit rose to 325 crores for the December 2024 quarter from 251 crores for the September quarter, a 29.5% increase despite revenue collapse. Earnings per share improved to 2.25 from 1.74 quarter on quarter basis. What drove the revenues up? Firstly, operating profit margins grew dramatically from 1% to 5% quarter to quarter basis. Secondly, other income swung from minus 17 crores to a positive 169 crores, which also added to the profitability. And thirdly, expenses declined proportionally with revenue. 4,295 crores versus 24,839 crores quarter on quarter basis, indicating effective variable cost management. Management, in their commentary, have attributed a shift towards higher margin protection products in quarter 3, which resulted in revenue loss. Also, despite lower premium collections, the company maintained a robust operating profit of 241 crores versus 319 crores in the quarter 2 of financial year 2025. Better underwriting results and favorable mortality experience contributed to profitability. The revenue volatility with improved profitability demonstrates ICICI Prudential's ability to optimize its business model during challenging market conditions. The quarter 4 of financial year 2025 shows partial revenue recovery to 15,687 crores with sustained profit growth to 385 crores, confirming a temporary nature of quarter 3 revenue disruption while highlighting continued operational improvements in the company. Management response also suggests that the company raised 1400 crore rupees via NCD issue to bolster solvency, while pivoting to annuity products. 14% of annual premium equivalent growth in the quarter 3 and retail protection 24% year on year premium growth. Brokerages remain cautious of ICICI Prudential Life Insurance. Motilal Oswal cut the value of new businesses for financial year 2026 by 4% to 2,512 crore rupees, while Macquarie suggested that margin recovery timeline extended up to quarter 2 of financial year 2026. Comparison of valuation parameters of ICICI Prudential Life and HDFC Life shows that the PE ratio of ICICI Prudential is at 72.6, whereas for HDFC Life it stands at 85.6. Now, both are higher in comparison to the industry average of 51.15. Return on equity, 5-year average return on equity for ICICI Prudential Life Insurance stands at nearly 9.01%, whereas for HDFC Life stands at 10.9%. Debt to equity for ICICI Pru Life stands at 0.22 and is lower in case of HDFC Life, where it stands at 0.18. If we compare the product mix of the two companies, ICICI Prudential Life Insurance is heavily ULIP dominated with nearly 50.8% of its portfolio in ULIPs and 22.7% value of new business margin. For HDFC Life, it is a balanced mix: 38% ULIPs, 29% non-linked savings, driving 26% margin. HDFC's focus on non-par products, 23% of annual premium equivalent, provides stable cash flows, less susceptibility to market swings and corrections. Comparing distribution channels, ICICI Pru Bancassurance has 67% insurance share from ICICI Bank. For HDFC Life, multi-channel, where 44% is bancassurance, 31% agency, and 25% direct. HDFC Life's diversified channels reduce concentration risk, a critical factor post RBI's stringent bancassurance guidelines. Let us compare the long term performance and dividend analysis for the two companies. Now, for a period of 1 year, total returns in ICICI Pru stand at a negative 2.1%. For HDFC Life, it is 19.10% positive. Nifty Financials, whereas, is in a positive of 14.7% for the past 1 year. For the last 3 years, ICICI Prudential has given a CAGR return of 28.4, HDFC Life 31.2, whereas Nifty Financials has risen by 22.9. 5 years, if you compare, ICICI Prudential has given a CAGR return of 61% in the last 5 years. HDFC Life return of 45.32, whereas Nifty Financial has risen by 39.1% in the same period. ICICI Pru Life's outperformance in the 5 year bracket is basically because of aggressive ULIP push during 2020 and 2023 bull market, higher equity exposure in AUM of 61%, whereas for HDFC Life it stands at 54%. Comparing the dividend payout ratios for ICICI Prudential Life and HDFC Life, it can be seen that the payout ratios have consistently grown from 2021, starting at 8.2% in 2021. For 2025, ICICI's dividend payout ratio stood at 14.1. For HDFC Life, the ratio for 2021 stood at 20%, and in 2025, it has increased to 28%. Now, this gradual increase in payout aligns with IRDAI's 2024 guidelines, allowing insurers to distribute up to 15% of profit after tax as dividends to shareholders. HDFC Life's 28% yield remains more attractive for income investors. Checking the persistency ratios, the 13-month persistency ratio for ICICI Pru stands at 89.1%, whereas for HDFC Life stands at 87.4%. The 61-month persistency ratio, so policies remain active for that much period of time. So for 61-month, ICICI Pru's persistency ratio stands at 58.3%, which is higher than the industry average of 53.1%. For HDFC Life, the ratio stands way higher at 63%. Solvency ratio for ICICI Pru stands at 211.8% versus regulatory requirements of 150%. The same ratio for HDFC Life stands at 194%, which was a good increase from 187% in the previous quarter. What are the future growth drivers? Well, rural penetration is on the cards, where for ICICI Pru it stands at 12.7%. It is 18.4% for HDFC Life. 27% of new policies are bundled with critical illness covers. So, addition of health riders to the policies. Thirdly, ICICI Bank's digital ecosystem integration targets 15% online annual premium equivalent by financial year 2026. Whereas for HDFC pension AUM crossed 1 lakh crore mark, indicating strong performance in its pension products. HDFC Life is also aiming digital transformation with 90% of its queries, customer queries being solved by digital platforms. Certain challenges that the life insurance industry faces is the ULIP taxation, which was newly introduced, the 12.5% long term capital gains tax, and IRDAI's new 30-day clearance window could slow new launches of products. Checking the analyst consensus on target prices for the two stocks. Now, nearly 55% of the analysts have given a buy to strong buy target for ICICI Prudential Life Insurance with price ranging from 580 to 725. Whereas HDFC Life also has strong buy recommendations with Motilal Oswal giving a target price of 850 rupees per share. To conclude, ICICI Pru Life's financial year 2025 performance underscores the challenges of balancing growth and profitability in India's complex insurance market. While its 61% 5-year CAGR showcases execution capabilities, the quarter 3 of financial year 2025 stumble reveals structural vulnerabilities in over-indexing to ULIPs. The way forward for the company: product diversification, tech led distribution, and regulatory foresight. As HDFC Life demonstrates with its 26% value of new business margins, sustainable growth in life insurance hinges on aligning product strategy with India's evolving financial protection needs, a lesson ICICI Prudential must internalize to justify its premium valuations. What did you think of this comparison? Which of the two stocks would you prefer to invest in? Let me know in the comment section. If you have liked this analysis and the video, please like, share, and subscribe to our channel for more such informative content. Until next time, stay safe, happy Easter, and happy investing.